it really just starts with an investment account. It's so simple yet complex because nobody actually talks about it, and really is to protect it and reinforce it. My strategy that I've started doing, even though I started off slow, and really it's about compounding interest. Einstein said it was the eighth wonder of the world, and it really is, because it just grows in such crazy amounts, even if you just start. And really to protect it is different strategies. Mine is, I started with 40% in the like S&P 500, the American stocks. So yeah, mostly I did an even split between all the different sectors, tech, finance, everything. I did an even split across it. I want to diversify and not have to worry about it. It's a fund. It's not just, oh, I got to worry about what's my balance and everything. I just leave it in there. Don't worry about it. Then I have another 30% in real estate investment trust, and there's also different ones for farmland as well that actually pays you tax-free distributions. I can't believe nobody talks about tax-free distributions from real estate investment trust. It's because they're trusts that they could do tax-free distributions. That's kind of their whole point versus like an ETF and a stock. And also another 10% alternative investments, whatever. I kind of see, but it's more long term, like different. There was some individual stocks, like you could say that is an alternate investment, and there was a couple in just raw material ETFs. I don't expect to get too much money, and I also included bonds in there just in case there's something happens. That's kind of like the emergency fund. Really, if something happens right there, you could pull from the bonds instead of all your stocks in a market downturn. And the bonds pay like a 4 or 5% dividend, so just above inflation, which is not bad for a cash reserve. And really, the max should be 10%. You don't need more than that, otherwise it really stunts the growth of the fund. And then the rest of that 20%, for me, I just said it's up to you. You could do it in whatever. And really, kind of what I did is, for that other 20%, I chose blue chip stocks. Like, I chose the Fidelity Blue Chip Stock Index, the Vanguard one. I cut the losses by choosing different institutions because they all choose different things, and they have different fund managers and all this other political crap that you don't need. And so the best thing is to just invest in every single one. That way, if say Vanguard changes something and now some investors sell out, well, I didn't actually lose that much because I had some State Street, I had some Fidelity, I had some different ones like iShares. Really, that's the best thing. You need to diversify with ETFs too. It's not just about with stocks. And getting an ETF that is diversified, but you have to understand that institution manages that ETF, so you're not actually that diversified. And that is really, I think, that most don't even talk about. Even like some of the great investment fund managers, they want you only buying their fund, but what they don't tell you is that it's still just as risky as an individual stock, because of all the people who run that fund that could run it differently than somebody else. So why not have a little bit of each one? And really, you don't have to be rich. You could start with almost nothing. It's completely false that you need millions or billions of dollars. It's complete bogus. It really what some people say is it's too late, especially in, I mean, think about how countries started. They mostly started with city states and they started making those outward investments where they actually didn't start with much and they actually build that out. And you could do the same thing with even an investment account. You could also have a Roth IRA. I don't know about the 401k because I think that one is more if you're employed and making certain contributions that are tax free. But if you already had your own money on the side, you could already have different tax benefits by just splitting it 40%, 30, 10, and then the 20. That really, I mean, that 30% is going to matter more for the tax free benefits because it's in real estate investment trust. Even ETFs offer that benefit, which is, I don't know why that's legal, but it is, and I'll take it when I can. It's just not many people understand because, well, nobody talks about it. And really, to wrap it up, for a sovereign wealth fund, I mean, anybody could do it. It's not really the richest and all this stuff. It's more that you need an actual vision or even just some action. Like I started when I was younger. All I did was just put some money in whenever I wanted to that I could have spent on random stuff, but instead I have this fund sitting there with a bunch of money that just appreciates tax free. Because for me, the only tax I pay is the difference in cost basis and not the difference in the full amount, which is even better. So if I made 20%, say that year, and I was to sell it, I would only pay tax on the 20% I made, not on the full 100%, which I think really the tax benefits of that is absolutely insane. And then if you had it in real estate investment trust, and say they were paying a 6% is a bit high of a dividend, but maybe 4 to 5% dividends, which are tax free, plus appreciating capital, that's better than any treasury bill that will ever exist. Even though you should probably have some bonds to have a quick withdrawal and more for that emergency. But I mean, just the benefits of real estate investment trust, it's better than if you had your own property. You'd have to manage all these tenants, all this other stuff. Yeah, you're gonna have probably more capital appreciation, and you can do the 1031 exchange. But if you already invest into a company that does that, you don't have to worry about all these tenants and headaches. And the fact that you could do it for less than $100 is even crazier. It really is that simple. I mean, a good one that some people tend to invest in. I don't do too much in that specific real estate investment trust, but the O Corporation or O Realty. I'm not sure the exact name, but the ticker symbol is O. And that one really, they just have so many commercial properties that basically work as your own sovereign wealth fund if you combine it with all different ETFs and stuff. I mean, even if you had $1,000 laying around, if you laid it out in those percentages, maybe I'd take the 10% off for the bonds and emergency fund, because you're not really gonna do anything with $100 that don't capital appreciate. So really, if you're starting off small, do more riskier, and then as you go on, you want to actually have diminishing returns, because the risk actually spreads itself through that entire amount, and your statistical expected value goes up, because if you reduce the amount of possibilities where that depreciates, instead of like it reduces the amount of downside and everything, that actually increases your expected value, even if your diminishing returns are not as much. Like maybe instead of making the 12% from the S&P 500, you're making 9 or 10%. Even though you have diminishing returns, if your amount of outcomes in the downside are much lower than your upside of just that long-term capital appreciation, your expected value, your statistical expected value actually goes up than not many people realize, because in reality it's also just a numbers game. And if you can actually break that out through an average, like an expected value, the statistical upside goes up more than people expect and more than a robot can calculate. Because even if you put this into a calculator and you see, oh, my projected earnings are this much, well, that doesn't account for random stuff that happens. Especially if you invest in companies, the biggest thing that destroys companies are changes in management. And really, if you don't want to deal with all that crap, just make your own fund. You could also just not have any ETFs and just have a spread of, like, say 200 different individual stocks. Well, not really stocks, but different investments. You could just have real estate investment trust, investments, bonds, and really any alternative investments. That is actually a fund, and you can operate it exactly like a fund and take all the distributions and reinvest it individually to let the interest compound even more. Like, the S&P 500 yields a 12%, but it also pays a 1.5% dividend that could basically be reinvested every year, and it compounds every 3 months quarterly, because that's when usually the capital distributions are made. And really, if you let that compound, that could probably compound at a 13%, beating a mutual fund just by reinvesting your dividends and really taking those distributions and reinvesting it. Like, some people, they just want the investment, and then they want to take the distributions as a benefit. But actually, if you reinvest that distribution, it compounds quarterly. That really probably makes you a bigger return than a country.